Hey, it's Darius. So you know that the use of Excel on the CPA exam is going to be tested. And in BEC, I think one of the places that they'll start testing it is where you have to make some investment decisions. For example, you have an initial outflow of $18,000 to purchase a machine that's going to last for 5 years with an annual net cash inflow of $6,000 with no salvage value, and you have a required rate of return of 12%. Now, how could something like Excel help you with this quick calculation? And then what we'll do is we'll decide between different investments using Excel if this is the better investment or maybe something else is. Now, before we had the use of Excel, in a problem like this, you'd have to go to the table. First of all, you'd use the present value of an ordinary annuity, so you'd have to select the right table. You don't want the annuity due. You want the ordinary annuity because you're not getting the first cash inflow today. The first cash inflow isn't going to happen for about a year from now based on this estimate. So we're estimating 5 equal cash flows, but the first one to start a year from now. So the present value of an ordinary annuity at 12% for 5 periods comes out to 3.6048. So that's the factor we'd have to pull from the table if we weren't using Excel. So without Excel, we would then put the 3.6048 and multiply it by $6,000 cash flows, and we can then determine the present value of the future cash inflows just by multiplying it out. You need a calculator or whatever. And once you get the value from the calculator, you would then write it in, right, in the days before Excel, and you'd get 21,629. And then you could compare to today's outflow of $18,000, and you'd subtract, go back to the calculator maybe, and you'd find out that 3629 would be the net present value. So in the end, you'd come to the conclusion that this is a good investment because it's going to add 3,629 to the firm, and as long as your cost of capital is 12% and you have 5 periods, then it's going to add that kind of value, 3629, to the firm. Now, how can Excel help us do this faster so that we can be more flexible and be able to compare different investments quickly? So our goal is to be able to enter in cell F1 the rate of return, in this case 12%, and then in D3 we're going to put in the number of periods, which is 5, and the factor is going to pop up for us automatically. And to be able to do that is going to be able to make it much easier for us to compare investments. All right, so how do we tie the present value table to the spreadsheet so that when we want a 12% return in 5 periods, the factor pops up, but if we want a 10% return in 6 periods, the right factor would also pop up? How do we do that? So what we want to do is create a formula on Excel that will look up in the present value table the rate of return that we specified, and then tell it to find the present value factor in the row that corresponds to the number of periods that we specified. To get that present value table into our spreadsheet, we're going to use a function called Lookup. Lookup is an Excel function to look up and retrieve data from a specific row in a table. The H in Lookup stands for horizontal, where lookup values are going to appear in the first row of a table moving horizontally from left to right. So now you can see that in the first row of the table, here are the lookup values: 5%, 6%, 8%, 10%, and 12%. So we've got to write a formula that allows us to choose any one of the values in the first row, either 5%, 6%, 8%, 10%, or 12%. And because it's limited to just those 5, we're only going to be able to enter 5, 6, 8, 10, or 12% when we're done. This is what our formula is going to look like right here. Don't get intimidated by it. It's pretty long looking right now if you've never done one of these formulas. But every formula on Excel has to start with an equals, and then after the equals, we're going to have Lookup. The name of the function that we're going to be using is Lookup. There are 4 sections of the Lookup function, and they're separated by commas. If we want to see the 4 separate parts of the formula, we can click on FX. The first section is the lookup value. And the lookup value is the 12% rate of return, which happens to be located in F1. And that's why you see in lookup value, you see F1. The second part of our function is table array. And that's the table from which to retrieve the data. And for us, that's going to be the present value table. The present value of the ordinary annuity table that we want to build into our spreadsheet. So the B1 to F15 in the table array will include our entire present value table and maybe a couple of extra rows. Hey, it's Darius. We'll get right back to this important video on Excel and the increased use of it on the CPA exam. If you've been trying to pass the CPA exam and you've been struggling, maybe you're on the wrong road. You got to get on I-75 and take it to your next pass. So after you enjoy this video, don't just subscribe. Go to CPAexamtutoring.com and hit me up. Click the Ask Darius button. You can see all the frequently asked questions, and you can ask me anything, and I'll get back to you personally. And now back to our Excel video. Now we're on to the third part of the function, which is called row index number. This is where we indicate in the formula the row number from which to retrieve data. Cell D3, you can see it highlighted in yellow, is where we indicate the number of periods in our present value chart. Okay, now comes an interesting part with Excel. Because our first row contains rates of return, 5%, 6, 8, 10, and 12, we call those headers in Excel. Because we use an entire first row for those headers, our number of periods actually starts on the second row. And because of that, in the formula, we have to account for that. So in the row index number, that's why we're adding 1 to D3. That's why you see D3 plus 1 row. So in our spreadsheet, the number of periods that we indicated is 5. You can see it in D3. But when you go to the table in the Excel spreadsheet, because we have a first row of headers, the 5th period, the number of periods 5, is actually in the 6th row. And you have to account for that in the formula where it says row index number, the third function, by adding plus 1 to the D3. So by adding plus 1 to the D3, that's what brings us down to the 6th row. The last part of the 4-part function is range lookup, and you can see from inside here we have the word false. What does that mean? We chose the word false because in Excel formulas, false refers to returning an exact match rather than an approximate match. If we wanted just an approximate match, we could have gotten away with true or just not put anything there as a default. Now we have our entire formula. So now we have our formula, starting with the equal sign, and then the lookup, which is our function, and then into the parentheses we go for the 4 parts of the function. And now we have our complete formula with all 4 parts, starting with the equal sign, then lookup, which is our function, and then into the parentheses we go. Separated by commas are the 4 parts of our function. So if we want to remember the 4 parts of the function, we can click on FX, and there it pops up. Starting with lookup value, we have F1. F1 is where we are going to be able to indicate the variable, which in this case is the rate of return. And when we want to select from different investments, this will be good because we'll be able to put in different rates of return since we built the table, the present value table, into our formula. The second part of the function, table array, takes us to our present value chart, which we built into the formula, and the coordinates B1, F15 shows us that we have included all of that part of the table. The third function, the row index, is the row number from which to retrieve the data from our present value table. D3 is where we put our next variable, which is the number of periods, which is 5 in this exercise. But the way we're going to do this formula, if we wanted 6 periods or 3 periods, we'll be able to change it. The amount of periods, which is 5, is actually found in the 6th row of the present value table because of the header, which is the rates of return. So that's why in the formula for row index, we have D3 plus 1. So D3 in our sheet is 5, but we have to add 1 because of the header. So that 5 plus 1 equals row number 6. And row number 6 is where we find the number of periods 5, which is 3.6048 as our factor. The last part of the function is where we put in true or false. False, we indicate that we want to find an exact match. And that's what we want. We want to take the exact amount from the table, not a close estimate. If we wanted a close estimate, we could go with true, or we would put nothing there, and it would default to true. So we're starting with the idea that we have an investment opportunity that's going to cost $18,000 today. If we make that investment, we're expecting $6,000 of after-tax annual cash inflows over 5 periods, and we need to earn 12%. So if we want to do a net present value, the factor comes out to 3.6048, and the total amount of the inflows based on present value would be $21,628.80 based on a factor of 3.6048. And that comes out to a net present value of $3628.80. Now that's just one investment opportunity. What if we wanted to compare 4 or 5 other investments on the CPA exam in the amount of time they give you? This spreadsheet with the formula, the function that we just installed, let's see how it will be able to help us save time and be accurate. So on the CPA exam, they could ask unlimited amount of questions regarding this kind of thing. For example, what if they told us instead of a 12% return, management needed to earn a 10% return? How much more would you return on a net present value basis if 10% was your desired rate of return? And based on the formula, you can quickly see that your rate of return would be 10% and your net present value would be $4744.80 instead of at 12% only $3628.80. What if we only had 4 periods of inflows instead of 5? Would we still have a net present value that's positive? Let's see. We can quickly drop in the 4 for number of periods, and you can see you'd barely make it with a positive net present value, but you would make it. $224.40 would still be a positive NPV. So on the BEC exam, if you had to compare different investments with different outflows and different rates of return, you could do it relatively quickly once you had this formula built. For example, we've been using an $18,000 outflow, but what if our outflow was only $13,000? Or what if our outflow was $22,000? You can see where the present value would turn negative and the different rates of return. We can continue to change the rates of return and the number of periods and very quickly determine net present value. So while the exam is promising an increased use of Excel, I could see in the area of BEC something like this, a net present value calculation, to be perfect for this kind of question.